Today's podcast is brought to you by the Freedom Day Dividend ETF. We know Ryan Kruger very well. Ryan and his team have been managing money for private clients through many market cycles since 1996. Their strategy is focused on finding companies with the potential to increase their dividends. Now, for the first time, they're offering an actively managed ETF for investors everywhere. The ticker symbol is MBOX, MBOX, as in mailbox, designed for shareholders searching for opportunities to receive more mailbox money.
The fund's investment objectives, risks, charges, and expenses must be considered carefully before investing. For this and other important information about the fund, please visit freedomdaydividend.com for a prospectus or summary prospectus. Read it carefully before investing.
Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Justin Carbonneau and Jack Forehand are principals at Validea Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital.
Hey guys, this is Justin. In this episode of Excess Returns, Jack and I talk through some of the lessons we've learned over the past year or so, from the market as a voting machine to how investors may define the long term, especially when it comes to factors, to thinking in terms of probabilities versus certainties, to why there will always probably be a reason to sell, and how very few people are doing the math. These are just a few of the observations we wanted to share as we continue to learn and grow over time in the markets. Thanks to everyone who has taken the time to listen to Excess Returns. We appreciate it. Jack, before we jump into it today, I just wanted to take a second to debrief on the last 12 months of the Excess Returns podcast. You and I have produced 65 different episodes, and we've been privileged to sit down and be joined by some great guests, including Michael Mauboussin, Sheridan Titman, Cullen Roach, Ben Inker, Corey Hofstein, Rob Arnott, Robert Hagstrom, and some names that people might not be as familiar with, like Ryan Kruger, Bill Sweet, and Perth Toll. I'm leaving out many, many other people who took the time to share their thoughts and wisdom with us and our listeners and viewers. But here's the thing. I'm not sure any of the people that joined us would have taken the time out to speak with us if it wasn't for the fact that we had listeners and viewers that watched Excess Returns. People have taken their time out of their busy schedules and lives to learn about investing, and from the guests we've had on and the material we're putting out. There are hundreds, maybe even thousands of finance or investing related podcasts out there. So the fact that people chose to listen to us, we're very grateful for that. We hope to continue to bring you good and valuable content throughout 2022. So thank you very much for everyone that's listened.
Yeah, we, just to comment on that quick, we didn't know. I mean, obviously when we started this, we had no idea what to expect, and we're 2+ years in now, and every we just interviewed Michael Mauboussin, as you mentioned. Like every time we ask someone like that to come on, like I'm still shocked they say yes. I can't understand why they would come on and talk to us, but it's it's been awesome, and it's been a really good learning experience, and it's a great way for us to learn from these people, because if we wanted to just reach out to these people, say do an hour call with us just so we can pick your brain about investing, a lot of the people probably wouldn't say yes, but because of the podcast, we've been able to do that. So it's been a really cool opportunity for us to do this.
Yeah, so for this episode, Jack and I are going back to the old school original days where it was just him and I talking about a specific investing topic or concept or article. So it's not going to be an interview like we've had the past couple months today.
Yeah, I was just thinking, the last time we did this with just you and me was it's been months at least. So it's probably going to be a significant letdown for the, considering the guests we've had recently, it's probably going to be a significant letdown for the audience to have to listen to me ramble on about whatever I'm going to ramble on about. But nonetheless, it's good to do these occasionally.
Yeah, so for today, we wanted to talk about lessons that we've learned throughout the last year, maybe a little bit longer when it comes to investing. And obviously, every market you go through, every year you go through in the market, every different market environment, provides an opportunity to sort of take a step back and think about the lessons that we've learned, the things that maybe areas we were right, areas we were wrong, what's changed in the market, and just overall sort of some hopefully timeless things and lessons that investors can sort of think about as they think about investing and being successful in the market over time. And Jack, we're going to use, at least to start, an article you wrote around the lessons that you learned throughout 2021. We'll use that as a jumping off point, and then we'll sort of build off some of these points, and then I'll add in some things at the end.
Yeah, it's been a really, and this is really lessons from the post-pandemic period, if anything, because the market has really been a little bit different in the post-2020, at the end of the pandemic and at the end of the bear market. We've had a lot of things going on in the market that have sort of, especially for fundamental investors like us, and particularly for people who use value like we do, we've had a lot of things going on that maybe haven't understood as well as maybe the way the market worked before that. And so what I was doing with this article is I was just trying to work through some of that stuff in my own mind, and I figured I might as well write it down. And some of these are lessons directly related to 2021. Some of them are sort of continuing to learn lessons that I've been learning prior to 2021. But I wanted to just write down some of the major points that I want to keep in mind as we run fundamental strategies going forward.
So there's that famous quote from Buffett: in the short run, the market's a voting machine. In the long run, it's a weighing machine. Now, there's some debate as to which Buffett actually credits Graham for being the originator of at least part of that quote. But your point number one in your article is the market is actually always a voting machine.
Yeah, and this is something I've sort of been learning over the last few years. I use that quote all the time in my articles to try to enforce the idea that eventually fundamentals will matter, and eventually fundamentals are determine what happens with the market. But the reality is that's not really true. The market is always a voting machine. So flows, what people want to buy and sell, I mean, that's always what's going to determine what happens with price. But what you hope as a fundamental investor is in the long term, obviously what we're buying here is portions of a business. And so you would hope over the long term that the people who are buying portions of these businesses would care about the fundamentals of the business. And so in effect, the market is a weighing machine, but it's only a weighing machine in that the market participants have to eventually care about fundamentals. And that's been one of the challenges we've seen sort of in the post-pandemic period, is this idea of, has the market cared at all about fundamentals, or has this been such a flows-driven market that they don't, the people participating in the market don't care about fundamentals at all? And, when we had Michael Mavis on the podcast, he pushed back on this a little bit, because I've been one of these people that's been saying, the market has been a voting machine. It hasn't cared at all about fundamentals. And he sort of pushed back and said, if you think about it, if you have a pandemic, the types of stocks the market rotated towards made sense, in the heart of the pandemic. And maybe the stocks that it rotated to, when the economy started coming back, that made sense as well. And, when you look at areas like electric vehicles, which he referenced, the market's trying to figure out who the winners are going to be. And so what can look like the market not caring about fundamentals can be really more the market trying to determine what those fundamentals are going to be over a long period of time. So the big takeaway for me, though, is that it's just important to keep in mind that voting is really what matters. And eventually you hope that voting will be based on fundamentals. But all of us who are fundamental investors need to say, I can't say this year or next year or the year after that suddenly fundamentals are going to come back into the picture. It's really something that you'd expect to happen over the long term as people care about the businesses they're buying.
And I think what both Graham and Buffett were really trying to get at with that quote is investor psychology. And, the market we're in, the market we've been in the past, 2 years, investor psychology has played a very important role in terms of driving the price of some of these stocks. So that's the voting mechanism that happens, especially in the short run, day to day, with meme stocks, with, sort of the different types of investors, whether it be the retail investor or the Reddit crowd. And really this fear and greed that kicks around stock prices day to day, that's oftentimes not tethered to the fundamentals. And obviously they can get very disjointed. Prices can get very disjointed from the fundamentals because of the voting that's taking place. But to your point, in the long run, hopefully fundamentals do matter and will continue to matter. They should. And that's where the weighing comes in. Number two is it is important to understand what the really long-term means. So what were you really trying to get at with that?
Yeah, this is getting at the definition of long-term. We sort of throughout our careers have had two different definitions of long-term. We had our own definition of long-term, and then we've had the definition that people, clients have had of the long-term. And so we've always had a pretty long definition of the long-term. Clients will typically come in and follow these types of factor strategies we run. And, they probably define the long-term as something like 3 years. So if they haven't seen results in 3 years, they're sort of questioning whether the strategy works. We've probably always had something like, say, a 10-year time frame in terms of how we judge these fundamental strategies. But I think my point here is I think both of us were too short in that period. Because if you look at what's gone on with value, I mean, we've easily had a 10+ year period where value struggled. And there's periods like that in the past as well. And so the challenge with these strategies is you really have to define the long term. I heard Meb Faber mention this on a podcast a while back. You probably, when you're running these types of factor strategies, have to define the long term as something like 20 years. And there's very few investors out there who can follow a strategy for 10+ years when it's not working. And so from my end, running these strategies, I think this just made me take a look, take a step back and say, and this is something I've been continuing to do over the last few years, and just say, what really is the long term? And I think the long term really is, when you talk about factor strategies, if you want to say, over what period would I say this strategy doesn't work anymore if it's not working? I mean, you're not looking at 10 years, you're looking at a period longer than that. And so that's just something that's important to keep in mind for us, for people who run the strategies, but also for people who follow them. If you're going to run, and we tend to advocate multi-factor, so we don't tend to advocate anybody following just value anyway. But if you're going to come in and you're just going to follow a strategy like value, you can't have a 5-year time frame. You can't even really have a 10-year time frame, because there's going to be periods where that strategy is going to struggle that long and you're going to abandon it at the wrong time. And so that was really what I was getting at here, is just, I think it's really important to understand what long-term means when you're running active strategies that differ from the market.
And by the way, I think that's very difficult for the vast majority of individual investors and maybe even institutions, because if you're having a conversation with someone that's allocated to let's say a, value strategy, that's a factor-based value strategy, and they're sitting on 3 years of underperformance, and they're asking, well, how long do I give a strategy like this? And you look at them, straight in the eye, and you say, you got to give this at least 10 years or another 50, the vast majority of people just kind of throw up their arms and they're like, I don't have that amount of time. So it's very difficult sometimes for investors to sort of wrap their arms around that and understand that. And that probably also is one of the reasons why, you shouldn't be like all in on these factor strategies if you don't have that type of very, very long-term discipline mindset.
Yeah, it's an argument on the first step. It's sort of an argument for multi-factor, because why would you follow, you've got these factors that work at different times. We know they can struggle for really long periods of time. Why would you follow just one factor when you can follow them all? And, I have this chart from Larry Swedroe I reference in some of my pieces, which has shown basically that when you blend these factors together, these long periods of underperformance get a lot shorter. So, that it's definitely an argument if you're going to follow factors for a multi-factor approach, but also it's an argument for a lot of people to say, maybe I should run a passive portfolio. Maybe I shouldn't follow these factors, because if I'm going to be the person, even if I run multi-factor, if I'm going to be the person after 3 or 5 years that's going to be saying, all right, I'm abandoning this strategy because it's not working, I probably am better off not following it in the first place and just following an index approach.
Yeah, that's a good point. The third one, and it's really relevant, I think, to this time of the year, because, coming into 2022, you have everyone making predictions about where the S&P is going to go, what the Fed's going to do with rates, where the 10-year is going to end. Everybody wants to make predictions. Everyone is making statements and giving forecasts with 100% certainty and conviction. But the reality of it is, when it comes to investing, probability over certainty is much more important.
Yeah, wait, are you attacking my forecast article I released last week?
Yes. Well, I will be scoring that at the end of the year to see how you got 5 out of 5 wrong.
And it will be completely wrong, which is the whole point of writing the forecast article. But nonetheless, we'll talk about that maybe on a different episode. But in general, yeah, I think every decision you make as an investor, it's important to put a probability to that decision, because when you do that, you sort of start to understand that there usually is a percentage on the other side of that decision. And some things have worked 100% of the time historically. Like, for instance, if you've invested in the stock market for a 20-year period historically, so far you've made money 100% of the time. That doesn't mean you will make money 100% of the time in the future, but it's good to sort of think of that, in a probability, context. And, the way this sort of came up for me is we talk about value investing all the time, and we talk about how value investing works over the long term, and we talk about how we think value investing is going to work going forward. And I think all of that is true, but there is a probability you put to that. That is not 100%. And I think it was Patrick O'Shaughnessy I was listening to that did a podcast, and he kind of said, if you want to be intellectually honest about this, you can't say there's 100% certainty value will work in the future. You can say there's a high probability value will work in the future because it has worked in the past. It makes sense based on fundamentals. I mean, there's a lot of reasons. We've gotten into the risk-based and the behavioral-based explanations. There's a lot of reasons to say value should work in the future, but you can't say it with 100% certainty. And so when you look at it that way, when I'm, as a value investor, looking at my portfolio, I'm going to be more likely to say, all right, if I think there's a chance, in the next 20 years, I'll just throw out a number. Let's say I think it's 90% in the next 20 years value is going to work and 10% it won't. Well, then I'm going to focus on that 10%. And I'm going to say, what would the world look like, sort of a pre-mortem? What would the world look like in that 10% if value didn't work? And that'll probably make me a better investor. And so this is something I took from Annie Duke's book, Thinking in Bets. The idea is just with everything in life, it's really good to sort of, as opposed to expressing certainty that I know this, it's better to look at it and say, all right, what are the odds I think this is going to work? Are they 90-10? Are they 70-30? Are they 50-50? Because that helps to put everything in the proper context.
You ended the article with, I'm just looking this up now because this is actually one of my favorite parts with Dumb and Dumber, but it's when when Lloyd is talking to like Mary, really likes this girl, and he's like, be straight up with me. He's like, what are the chances of a guy like me ever getting a girl like you? And she says, not good, Lloyd. And he says, not good, like 1 in 100. And she says, no, like 1 in a million. And a big smile comes on his face, and he says, so you're telling me there's a chance?
That's right. That was my heading for this last one, because there's a lot of things that happened in the market, in 2021 that you would put maybe in that category. The things I referenced that in the article, obviously the GameStop thing, which happened early in 2021. I mean, GameStop was up something like 2,000% in a month. If I said to you, I've got a gaming retailer, when the economy is largely shut down, that operates out of malls, and their stock is going to go up 2,000% in a month, you would have told me I'm crazy. There's no way that's possibly going to happen. And obviously that wasn't driven by fundamentals in any way. But, the whole point of this last one was to say, going back to that thing about probabilities before, is sometimes we'll assign 0 probability to something, and then that it happens anyway. The hedge funds that were short GameStop learned that there wasn't a 0% chance that GameStop will go up 2,000% in a month. Or, I also referenced the Shiba Inu whale in my article. Somebody invested $8,000 in Shiba Inu, and I believe they turned it into $5.6 billion in 14 months. Although obviously I think it's been more than cut in half since then. So, who would have thought, a currency named after a dog, you could have invested $8,000 in it and turned it into, at least on paper, $5.6 billion. So it's important for all of us to keep that in mind. And it's particularly important when if you're betting against something that you think is a 0% probability in the market, and then it comes true, sometimes you can really be caught, on the wrong side of something. And so, as like the hedge funds that shorted GameStop learned, sometimes that can be a really big problem. So the point in the last thing was just to say, there are a lot of things that we may assign a 0% probability to, but every year in the market, or at least every 5 years or whatever, something happens where all of us say, I didn't think there was any chance that could have possibly happened. And so it's just important to keep that in mind as investors. And, 2021 was a really good lesson in that regard.
Yeah, good point. Just a few other things from my perspective. And these are really all post-COVID too, so it's not specifically for 2021. But one of the things is I think since really March of 2020, there's been like a reset in investors' minds, and that's interesting to me. And I think it happened with the financial crisis too. It's like maybe it's true of all bear markets. I don't know, but there's some, and I think the last 2 big downturns we had, so the financial crisis and the COVID sell-off, which were very different. They were very different bear markets and very different market environments in so many ways. But what those did in investors' minds is they did put like a hard break in terms of how people assessed performance in their portfolios. It's like everything pre-COVID, it's almost like that was a different environment. And it was a different environment. It was a very different market. It was at least coming into that, it was a very narrowly led market environment with large cap tech mostly leading and certain things in the market working. And then you had the break, and then, a different set of things in the market started working, some of the speculative stuff, some of the growth stuff, but then also some of the value stuff but the point is that I think from a sort of mindset perspective for investors, it was a hard enough break where people almost didn't really care as much about how strategies did pre-COVID or maybe the last 10 years. It's almost like, how have things done recently?
Yeah, it's interesting too, because one of the big things we were all talking about, pre-COVID, was this whole idea of passive investing is getting too big, and it's affecting the market too much. And it's sort of like people just dropped that. Obviously there was dispersion is much bigger. Active type strategies are doing a lot better, and people have just sort of moved on from that passive thing. And it's still yet to be determined whether that passive trend will obviously people are still pouring money into passive. So will passives impact in the market? Will we kind of go back to the pre-COVID, approach to that, or whether we'll stay where we are now? But you're right. I mean, in a lot of ways, there's been this break in the market. And, I think what a lot of us are trying to understand with a lot of these things is, is this break going to be something long-term where a lot of these things that have happened post-COVID are going to continue? Or are we going to maybe go back to the regime we were in before there once this settles down? And, I don't know if the answer to it, but I think that's something a lot of people are thinking about.
I saw a chart, I think it was from Michael Batnick, and I thought this was really interesting. Now, this goes back probably like at least 10 years, but it was a chart of the market, steadily going up, obviously some dips, 2015, late 2018, 2020, of course. But it was like 40 reasons, or actually I tweeted it, and it was all these like reasons to worry and how the market was climbing a wall of worry all through this. And, you can make the argument that the Federal Reserve and low interest rates and all that kind of stuff, and that's true. But, there's always a reason to sell. And that's the one thing that, tomorrow we can wake up and well, not tomorrow, it's a Saturday, but Saturday or Monday or whatever. There's always reasons to be worried and sell, stocks. And at some point, for investors that want to try to time the market, that could be a good decision, although timing really doesn't work most of the time. But, there will be another bear market. There's certainly going to be corrections, but there's always going to be reasons to worry. And I think those investors that spend time worrying too much are probably the ones that don't end up doing as well. Like you can go back to like 2021 and think, in the summer of last year, and listen, this pandemic thing with the shutdown of the economy and everything, I mean, no one knows for sure. And no one could have had a playbook for this, right? Even as we were recovering. But, there was always reasons to be worried and sell and stuff. And most of those things actually didn't end up, the worrying of it wasn't productive for people's portfolios that were in the stock market. So that's just another thing that I sort of thought was worth mentioning here.
Yeah, and I probably should have had that in the article. That's a really good point. And, if you think about, like, there may not be a bigger example in history of climbing a wall of worry than the post-pandemic situation. Because, I mean, the wall has been massive. I mean, there's been every reason in the world the market should go down. And like you said, there's been just things piling on top of other things that are the reasons the market should go down. And what's interesting is eventually there'll be a reason the market does go down. But in retrospect, we won't remember any of those things that it should have gone down because of, and it didn't. We'll remember the thing that actually drove it down. And then we'll think, oh, I could have predicted that. Whereas, you've got to remember all these other reasons, all these other times while we were going up here where you thought, oh, the market's going to go down because of this or because of this. And, that's the problem. And that's why it's impossible to time the market is there's always a reason to sell. And sometimes, like in this period we've seen in 2020, 2021, there's massive reasons to sell, but it still doesn't work out. And so that's why it's just so difficult to try to figure out these things.
Yeah. My last point here, we'll just wrap it up is, I feel like, and maybe this is more of a pet peeve of mine rather than a lesson, although I think it can be a lesson for people that hear things and that want to back into, is this realistic to think about or assume that something's going to happen? But, very few people out there do the math. And what I mean by that is, whether you're in these clubhouse rooms about Bitcoin or whether you're thinking about Cathie Wood's ARK investments and you're looking at returns like, I don't know what Cathie Wood put up, potentially before the beginning of this year, she might have had one of the best 5-year track records of any mutual fund manager out there. She may have compounded at something like 50% per year for the last 5 years. I mean, if you look at Bitcoin up until the most recent decline, it might have been compounding out at like 200% a year for the last 5 years, something like that, maybe a little bit less. But the point is when you take the asset base of ARK or the market cap of Bitcoin, and you just assume that they're going to continue to compound at those rates in the future, you get things that are the size of things like $1 trillion asset in terms of market cap with Bitcoin compounded at 200% a year for 10 years. It gets you something like, I don't even know, you do the math, it's ridiculous. It doesn't seem feasible to me. So the point is that, when you see these crazy returns, I guess in smaller assets, they could happen, but as assets get bigger, you just have to ask yourself, is this realistic when I apply those returns to these numbers? Is that even at all feasible? And the answer probably in most cases is probably no.
Yeah. And that's, I mean, obviously, what ARK did is impressive. And obviously for people like us who've relied on fundamentals to invest, I mean, it's far better than what we've done. But you also have to, when what you're referencing there is, there was I think her forward projection for ARK was something like 20% a year. And then the price of the ETF went down and, now it's 40% a year. And so looking at that and just saying, is it feasible for a fund to really, any fund to return 40% a year? Is always something you want to question. And it's actually gone down more. So, might be 50 or 60 now, but that's always something just to keep in mind. I mean, those types of returns, almost nobody ever produces those kind of returns. And so it's not knocking a particular style of investing more than it's saying for all of us, for us included, when you see these numbers, it's important to try to dig into them and say, what's behind these numbers? What's going back to the probability thing we talked about before? What is the probability this will actually happen in the real world? Because sometimes you'll find some of these projections you see coming out of Wall Street, there's just no chance in reality they're actually going to happen.
So that's some of the lessons that we took away from last year, or really the last year or two. Hopefully you guys have found this is valuable, and we will see you next time.
Thank you.
Hi guys, this is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at JJ Carbonneau. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.